Now, restricted stock units, these ones are the most straightforward. It's just shares of stock that are given to you. Very easy. And they're going to have a vesting schedule. So, typically it'll vest over a period of time. But when the shares vest, whatever the stock is worth at the time that the RSUs vest, you're taxed at ordinary income rates on that value at that point in time. So RSUs, if they vest before your company goes public, that's great. And then, if you hold them for at least a year after that, any profits from a sale would be taxed at at long-term capital gains rates. But if your company is publicly traded when your shares vest, again, it's no different than a cash bonus. It's just in the form of stock instead of dollar bills. So if it was me, I would probably liquidate and then re-diversify elsewhere, since we're paying taxes on that full value regardless. For example, with RSUs, let's say you were given 1,000 RSUs back in February and they vest in February of next year, so a 1-year vesting schedule. And let's say the share price February of next year is $50 a share. So you have $50,000 worth of stock when they vest. You're going to be taxed as if you got a $50,000 bonus, and they tax you at ordinary income rates. And often companies, if you choose to hold on to the stock, they'll just withhold shares of stock to cover the tax bill for you. So, you don't have to write a check in April, but yeah, something to be aware of there. You're paying taxes on the full value. So if it was me, I would probably sell and re-diversify if the goal is to keep the money invested. Now, we get a lot of questions from people let me look at one other example. So RSUs, if we hold onto the stock, this is kind of a worst case scenario example, but I've got a client who I met pretty recently, actually. He used to work for a company called Amyris, and they had a very successful IPO about a decade ago. And the stock price shot up to about $500 a share within a few months of going public. And then it gradually started to whittle its way down. And he had a bunch of RSUs with the company. And when he started working, it was pretty exciting. Stock price was on fire. Everyone was excited. But his RSUs, based on their vesting schedule, they didn't vest until a few years later, and they were worth about $40 to $60 a share when they vested. So when they vested, he had to pay tax on that $40 a share value. But then it continued to slide over the years. And, as recently as November of 2020, the stock was trading at under $2 a share. He paid taxes at $40 a share for something that's only worth $2 a share now. Not ideal. Now, since then, the stock has rebounded a little bit and, it's brought some more excitement into his life. But, if in hindsight, it would have made more sense just if you were paying taxes at $40 a share to sell at $40 a share and then re-diversify elsewhere. Now, I'm not insinuating that this is going to happen with any of your company's stocks, but there's a possibility that it could happen. And that's kind of the worst case scenario if, stock starts to tumble, but you already paid taxes at a high value. Now you're stuck with some significant losses on that stock.